a Google search for a list of the top 10 investing books, and you're likely to find a book by Benjamin Graham, a Peter Lynch, a Bogle, something on Buffett, Munger, Greenblatt, Munish Babra, etc. Now, these are all brilliant investors whose investment approach has been read, reviewed, and discussed many times in the past. But this video is about a not so popular book which features a brilliant but not so popular investor who himself got into investing by reading a not so popular book. So our story starts in 1973 when a 35-year-old Peter Cundill read the book Super Money on a Plane Trip, and this is where he was first introduced to the investing philosophy of Benjamin Graham and David Dodds via their classical book Security Analysis. Mr. Cundill found an immediate liking to Graham's work and seriously took upon the value style of investing, which led to the formation of the Cundill Value Fund in 1975, which over the next 33 years has averaged a CAGR of 15.2%. To put it differently, if one had invested $10,000 in that value fund in 1975, the money would have grown to a little over $1 million during those 33 years. Now, in this video, we shall examine some of Peter Cundill's key investing strategies, how he was influenced by Graham, and some insights that he developed that allowed him to generate 100x returns for his investors. A lot of what the book's author, Christopher Riso-Gill, has compiled is from Peter Cundill himself, with ample quotations, speeches, and investment letters, making the book a very wonderful read. In fact, if there's one thing which I think was copied from someplace else, then it's the title of the book, which is a quote by Irving Kahn, who said, "There's always something to do. You just have to look harder, be creative, and be a little flexible." This quote perfectly describes Peter Cundill's astute, intellectually rigorous, and likable character, and this book is recommended reading for anyone who is interested in active investment management. Let's begin. Peter Cundill had not come up with his own investment philosophy before reading Ben Graham, but had certainly come up with some early conclusions. For instance, Cundill was convinced that a company's management's ability to predict earnings was universally poor. Further, he found better use of his time in analyzing industries rather than predicting national or international economies. And thirdly, Cundill always believed that it was very important for every investor to develop a precise investment policy to take maximum advantage of the stock markets. These convictions led Peter Cundill to study successful companies in order to look for common characteristics that could help him duplicate those results. More specifically, he looked at metrics like the book value, dividend growth, EPS growth, available float, flow of funds, etc., and then gave each metric a weighting that eventually led to a comprehensive stock score. Now, once Cundill started imbibing the Graham way of investing, that is the value investing approach, his investing philosophy started to become all the more clearer to him. Basically, he came to the realization that a stock isn't cheap simply because it has a low P ratio, a nice dividend yield, or even a high growth rate. And while yes, these things may be good to have, but according to Cundill's newfound investing philosophy, a stock is cheap when the careful analysis of the company's balance sheet reveals that the stock's price is meaningfully lower than its intrinsic value. As you might have guessed, there were serious shades of the classical Graham and Dodds style margin of safety investing, and this is what Peter Cundill excelled at. He further realized that value investing tends to work in an opposite direction to market trends and naturally reinforce the axiom of not losing money. So when the markets are excessively priced, fewer bargains exist, which naturally drove value investors like Cundill to sell stocks and hoard cash instead, thus reducing portfolio risk. And the exact opposite happens at times when there is fear amongst investors and even excellent companies are available at inexpensive valuations. In fact, Cundill is known to use this Ben Graham phrase, which Graham himself picked from the Roman poet Horace, who many centuries ago said, "Many shall be restored that now are fallen, and many shall fall that are now held in honor." Cundill marked these two extremes from an investor's standpoint as the difference between patience and stubbornness, and we learn a bit more about it in later sections of this video. The Cundill Value Fund was formed in 1975 and it hit the ground running immediately. The fund's returns in the first 3 years were 32%, again 32%, and 21% respectively. The 5-year annual returns exceeded 30%, and on its first 10-year anniversary, the Cundill Value Fund showed a CAGR of 26%. In fact, the Value Fund had its first loss year in 1990, which was a good 15 years since the start of business. Now, Peter Cundill's investing philosophy, as one might have guessed, involved deep value investing. This required the development of a few criteria which the Value Fund followed in a disciplined manner and included things like the share price must be less than the book value and preferably should be lower than the net current asset value, which is something we learned in the Rakesh Jhunjhunwala and Titan Industries video on the ET Money YouTube channel. Then the share price must be less than 1/2 of its former all-time high, a P ratio of less than 10, and earnings yield which is greater than the long-term corporate bond rate. The company should be profitable, it should be paying dividend and increasing it over time, etc. In essence, Cundill's playbook was adapted in large parts from the Graham School of Investing, although he did involve studies on expected future rates of profitability, the quality of management, and the various underlying factors governing sales volumes, costs, and profits. Over time, Cundill also got into distressed debt, which required a determination of whether the reorganized or liquidated business was worth more than the price of debt. As we can see here, the main focus, or in other words, Peter Cundill's circle of competence was always on the value of net assets, which not only included evaluating the visible assets, but also included looking for hidden assets like goodwill that companies carry on their books at values that were much lower than the actual value. In fact, the book gave an example of the jewelry retailer Tiffany's, which in 1974 carried its famous Tiffany diamond whose offer price was $2 million and was at just $1 in its balance sheet. Further, Tiffany also owned real estate in Manhattan's Fifth Avenue, which is one of the most expensive shopping streets in the world, and these properties were listed in the company's book at its 1940 property price, which was a drastic undervaluation of the asset. This convinced Cundill that the Tiffany shares were being traded way below its book value and even its liquidation value, which made him take an almost riskless position in the company. In terms of selling rules, that is when to sell, it's interesting to note that the Cundill Value Fund would automatically sell half of its position in a stock after its share price has doubled. This way, the fund was protecting its capital, and the part which remains unsold is left to the fund manager's discretion on whether he wanted to continue with it or dispose of that as well. Cundill was also big on traveling internationally every year as he looked for bargains, and more specifically looked for bargains in countries that had the worst performing stock market over the prior 11 months. He traveled to better understand the culture, politics, and business environment of that country, and his networking with other local value investors became a vital source of potential investment ideas. In the book, one finds that the author has dedicated many pages in discussing how Peter Cundill would characterize the qualities of a successful investor, which I, for one, found very insightful and helpful. One lesson that permeates through the book is Cundill's experience that even the greatest of investments will go through rough patches, and it is important for investors to not panic and instead expect it to happen. I am reminded here of Apple, which in spite of being the world's largest company by market capitalization, has had a roller coaster ride with its stock going through 4 different drops of 40% each in the last 20 years. In that context, Cundill, in his speeches and interviews, has always advocated patience amongst investors and for them to focus on earning consistent above average returns by taking below average risk. In other words, don't get greedy, which he then specifies with a target expected return in the middle teens, so say 14 to 17%, which can be achieved over a very long period of time, like what the Cundill Value Fund did with its 33-year track record of clocking 15.2%. Peter Cundill also talks extensively on humility and focus, often reprimanding investors who seem to be seeking excitement over steady returns. Essentially, he suggests investors to be clear on their priorities and to create an investing approach that can be best suited to their goals, skills, and risk tolerance level. Flexibility is yet another area that Cundill preached and often related that to the best sportspersons who practice the art of adaptive perfectionism to get better than everybody else. This is visible in investing as well, and while in Cundill's case he had faith in Ben Graham's principles, he also kept a keen eye on adapting those principles to fit today's investing world. And finally, I'd like to list out what Peter Cundill says are the 10 essential traits of a successful investor. These includes firstly curiosity, which means reading broadly, talking to more people, listening with attention, and to have a constant exchange of thoughts that can develop one's sense of perspective in all matters. Secondly, there is patience, and more patience. Then concentration, that is the ability to focus and block out all distractions. Number 4 is attention to details, which means never missing out on the fine print, especially when reading financial statements and earnings reports. The 5th trait is taking calculated risks, which is very different from gambling. Also, a successful investor needs to have an independent mind in the sense that he or she should develop a contrarian mindset with a keen sense of connecting the dots. Point 7 is humility, which does not mean one losing self-belief, but more importantly, it means not attracting an ego that can never be wrong. The next trait is consistency and routines, and that's really where discipline and compounding habits and everyday improvements comes from. Trait number 9 is to have a sound body along with a sound mind, and Cundill believes that engaging in competitive sports or similar activities teaches investors to temper competitive instincts with common sense. And the final trait needed of a good investor, per Peter Cundill, is to take personal responsibility for one's actions and investment results. This not only keeps one grounded, but also forces the investor to establish valid reasoning around the results and to learn from one's mistakes. So these were some insights that I picked from the book, and for more details beyond this precursor, do pick a copy of this wonderful book and read it the next time you're on a flight, a lot like how Peter Cundill did that some 50 years ago. Once again, thank you for your time. Do subscribe to this channel, do like this video, and I look forward to catching up with you soon. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.